In this topic, we're going to look at why we need to understand internal controls, what exactly are systems of internal controls, how we gather evidence, how we document our understanding, assessing the design of internal controls, and then coming up with our preliminary assessment of control risk, which we know goes into the audit risk model and will have an impact on our audit strategy. Some quick abbreviations I wanted to raise with you. Systems of internal control, which we'll see as SIC. An alternative sometimes is that you might see something called ICS, which is internal control system. It's pretty much the same thing. There was a slight change in the naming convention of the internal control framework over the last few years. So some places you might see ICS online, but we try and use SIC. Internal controls are often abbreviated to IC. So now I wanted to talk a little bit about the context. Where does this particular topic fall into everything else? So we know that the very end of our audit is our audit opinion or our audit report. Now I know that to be able to give that report, I need to gather evidence that the financial statements are free from material misstatement. So I have to figure out how to do that. And that means I need to understand materiality. So I need to understand materiality. I also need to have some sort of program to go ahead and collect my audit evidence. And that program needs to make sure that my evidence also meets my assertions. And I know that I've got my balance and my transaction assertions. Now, the way in which I go ahead and I collect evidence, which is really my audit program, is going to be highly impacted by something called our audit risk model. Now we know that the audit risk model has a couple of different components. We know that what determines our audit program is our detection risk, our risk of not detecting a material misstatement. But we also know that our audit risk model is driven by the inherent risk and the control risk of our client. And to be able to determine what the level of inherent and control risk, whether it's low, medium, or high, then one of the key things we need to do is we need to understand the client. So I'm sort of working backwards here in the process. So we've covered understanding the client in regards to identifying inherent risks for risks of material misstatement. But today what we're going to focus on is how understanding the client helps us come up with an exact control risk assessment. So both of these, remember, our ROMs feed into our audit risk model. And so today we're going to be looking at ROMs related to our internal controls and how they help us in deciding what sort of audit program we're going to use to be able to collect audit evidence. So let's get into it. Our first topic in this module is about why we need to understand internal controls. And the why question is really important because if you don't understand how internal controls fit in and how they might actually help us on the audit, then you're going to potentially miss something. So let's get into this topic. So first off, let me diagrammatically explain why we need to worry about systems of internal control. So I'm going to start here with some accounting data. All right, imagine that's the pool of all of the transactions from our information systems that helps us generate our financial reports. Now, our system of internal controls really acts as a barrier around our accounting data. And these little X's here with the little circles are essentially control checkpoints. All right. So if you have a transaction that is correct, it meets all of the assertions, what should happen is that you try and enter the transaction, the control system does a little check, is this transaction correct? And if it's correct, it goes, yeah, come on into my accounting data. So the internal control systems for transactions that are true and fair should allow them into our accounting data so that therefore all of the accounting data is correct. We don't have to worry about are there any misstatements because our control system does a good job of letting those proper transactions in. Now the control system should also, when you have an incorrect transaction, bounce it out. So it will prevent incorrect transactions from being recorded, all right? Because what we don't want is that we don't want to pollute our accounting data that you can see there within that blue circle. So we want internal controls that allow correct transactions in, prevent incorrect transactions from coming into the system. Now, what happens if one of your controls is not there? So here in this particular example, I'm removing one of the internal controls, and you can see here there's a little gap. Well, if you have a system where either the control is not working, so a control not working means that a false transaction comes in and it pollutes our data, or you end up with a situation in which the control is missing. So there's not even a broken control that lets something through it shouldn't. If you have a control that's missing, again, more false transactions are going to get into your accounting data and pollute that pool. As an auditor, I've got a couple of different options when it comes to gathering evidence. If my controls are really good, I can test this protective layer, okay? And I can focus on testing the protective layer. If the protective layer does its job, then the accounting data underneath must be correct. If I've got a leaky bucket, all right, an idea of a poor internal control system is like the controls are like the bucket. If the bucket has a hole in it, then there's no point in actually testing the controls. I might as well go in and I just test the individual transactions. So I've really got two options. Number one, I can worry about testing the control system, or number two, I worry about testing the data inside, or some mix of the two. Now, why is understanding internal controls really important to us? Well, if I know where controls can go wrong, like this one here, or where there's a weakness in the internal control, then I know that's where to look for material misstatements. It helps me actually narrow down my focus of where I could investigate. And that's the whole gist of this particular topic. It's helping us understand what are the internal controls, where are the weaknesses, where are the gaps, and how does that help me collect my audit evidence in a way that's more efficient? Rather than look everywhere, I know exactly where to look in these areas of greater risk. So let's get into some more detail. So to sum up, why do we need to understand systems of internal control? Number one, ASA 315 says we must. So in that standard, it says we have to understand them. Number two, it's part of the audit risk model. If we don't have, remember our audit risk model is AR over IR times CR. So if I don't have CR over here, I'm going to be a bit stuck in trying to use the model. Number three, a weakness in the internal controls. I mentioned that a gap or a poorly operating control can allow errors or misstatements. This increases the risk, and then we need to adjust our audit strategy. But remember, we can take advantage of knowing where these gaps are to help us plan the audit more effectively. So let's look at what exactly are the systems of internal control. I did cover this very briefly in the earlier risks of material misstatement introduction video, but now we're going to get into it in more detail. So are we interested in every single internal control? According to ASA 315.21, we're only interested in the controls relating to preparing the financial report. So in reality, this means I'm interested in pretty much every single internal control relating to a business function. That's related to sales, purchasing, property, plant, equipment, warehousing, employees, executive compensation, marketing, legal fees. So we're really interested in pretty much every internal control that relates to the use of or spending money. So a reminder of our systems of internal control components, and I suggest that you go back So in terms of the reading for this topic, I want you to go through and I want you to read in detail paragraphs 21 to 26 of ASA 315 because that gives you lots of detail of what is covered in the systems of internal control. But a reminder, it's the control environment, it's risk assessment. So what do they do to assess their own business risks? It's control activities, it's information systems and IT communications, and then the last one is monitoring. So why is monitoring so important? Monitoring is critical because monitoring is the process in which we check whether our control activities are actually working or not. So one of the issues, let's for example think about an ATM, all right, a machine that dispenses cash. Every time someone puts their card in and they add their PIN, then a control actually happens to match the PIN to the card before you can make a transaction. Now, essentially, every time that PIN match process happens is an internal control. I don't necessarily want to know every single time that that control does work. But what I do want to know as part of my monitoring process is I want to know the very first time the PIN matching doesn't work. What's causing that issue? Think about the train turnstiles at a train station. Every time you tap your card and it opens, that's great, the control is working. But every time you tap and it doesn't work, well, that's a control starting to break down. And that's really important for us because when a control doesn't work, then what we're doing is we're increasing the risk of fraud or error, which is essentially increasing the risk of material misstatements. So we want to know when a control's working, but more importantly, I want to know when controls stop working. Because when they stop working, that's when I can narrow down my window to where I can find the potential misstatements. And that's really useful for me as an auditor. It means I don't need to check everywhere for errors. I can check in some very specific places by understanding the internal controls. So a note on control activities. When a business does have a risk, and these are business risks, not audit risks here, when you have a risk, you've got 4 different options. Number 1, you could prevent the risk from occurring. Number 2, you could detect the risk when it does occur. Number 3, you could insure against the risk occurring. Or number 4, you could avoid the risk. So think about the risk of theft. So what could you do to prevent the risk from occurring? If you're a supermarket, you might have security cameras or you might have RFID tracking on items so that you can keep track of what's happening. You might advertise to customers, oh look, we're doing things to prevent theft. If a theft does attempt to happen, then often if you have those little RFID tags, you try and walk out the store, beep, 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 well, we're preventing and we're detecting the risk from happening in that instance. An option that's not often talked about in textbooks is that you could insure against the risk occurring. So if you were worried that a factory fire might burn down your factory and all of the inventory inside it, you could take out an insurance policy to try and give you some payback if that risk did eventuate. The other option is that you could avoid the risk. So you could, if there was a lot of risk involved in being in a particular market or making a particular product, you could just decide not to do it. From an audit perspective, we're mostly looking at internal controls that prevent a risk from occurring or detect a risk once it has occurred. So for example, when you log into your student systems, there is a control there that matches your ID to your password, and that's to prevent people from having unauthorized access into the system. You can only enroll in certain subjects. That's a control to prevent you from accidentally enrolling into the wrong thing. If perhaps we have any students who don't sit the exam, then a risk is that some students might not get the right result. We have processes to detect when students haven't come to exams or they haven't submitted assessment tasks. So in business, we're going to look for controls that prevent a risk from happening or detect a risk when it does occur. Auditors are looking for controls that prevent or detect our potential misstatements. So how exactly do I gather evidence on systems of internal control, on the pyramid and all of the control activities? Well, number one, we start by interviewing the client. This is why for auditors, communication skills are one of the most important things that we ask people to develop and that audit firms are looking for in their graduate candidates and their interns. Can you meet someone new? Can you try and connect with them? Can you ask them questions in a way that's appropriate? This is not a lawsuit where you can go up to the client and say, tell me what's going on. What are you doing? I found something suspicious. What's happening with sales? You can't go ahead and do that. We have to ask clients for information in a way that's professional, that if we suspect something also doesn't give away that we might suspect that they might be doing the wrong thing. So communication skills is really, really critical, and interviewing the client is always where we start. The second thing, and the thing I always love to do, is go for a tour. All right, find out, how does the business work? Show me the factory, show me the mining site, show me the call center, or let me meet some of the employees that provide the service. Going for a tour will give you an idea of what's happening in the company, and that might also help you reconcile between information they might give you in the interview and what you see. Sometimes those things don't actually mesh together. The client might say, oh, we do all of this, and then you go for a tour and you look at the process, and then you find out they're not doing half the things that they say they're doing. So going for a tour is important. And the next one is to observe a process flow. And when I say a process flow, I mean something like you might observe them processing sales, all right, or collecting accounts receivable, or paying payments for accounts payable. So normally we do like an overarching interview with management. Tell me about the client. And this is all part of our understanding the business and identifying inherent risks. But then once it gets down into individual transactions, you'll meet with smaller teams. You'll say, oh, look, can I talk to the person who manages sales? Can I talk to the head of accounting who handles accounts receivable or accounts payable? We're looking for controls to try and prevent or detect misstatements. And in this process, we're also trying to identify, are there any weaknesses? Is there a control that's missing? Do I see a gap? Do I see a potential place where someone could make a mistake or engage in fraud? So we've understood our process. We've asked the client, walk us through, tell us what it is, show us the documents. So now we need to actually put that together in some form of documentation for our own audit systems. So remember, ASA 230 requires us to document our work. And there are three main ways to actually go about documenting an understanding of our systems of internal control. Number one is a narrative. And a narrative is really a story. And then they did this, and then they do this. And then it goes to this person for processing. And then the document gets filed, and then something else happens. So the narrative is a really big story. But when you're typing out a process as a narrative, it can get quite complicated. The next option is the flowchart. This is my favorite, where we take the process as we understand it and represent it with symbols in a diagram. The last option is a checklist. A checklist is essentially a list of all the questions you ask the client. Yes, no, what is the information? So what are the pros and cons of each of these options? Well, that's our next step so that you can decide which one to use. So what are the advantages and disadvantages of each of these options? Well, the narrative is that it's very rich. There's a lot of detail in the narrative. The disadvantage is that it can become very long. Partners don't have and managers don't have time to read 3 pages of your descriptions of the process. So they can be long and they could be difficult to read depending on the person who's writing it. Now, the advantage of the flowchart is that pictures convey meaning. All right. It's easy to map often an entire process onto 1 or 2 pages. We have standardized ways of drawing flowcharts, and people can often look at things and better understand things diagrammatically than they could if you were using the narrative. The disadvantage, of course, is that it does condense information somewhat. So you don't have that same level of detail, and you do need to learn the skill in how to draw the diagram. The advantage of the checklist is that really anyone can use them. So you don't need to have a lot of experience with the client to use a checklist. You take your checklist to the interview and you just ask them a whole lot of questions. However, clients don't like checklists. All right, it's not very easy for them, if you're interviewing them, to say like, oh, do you do this, do you do this, do you do this? They would much prefer saying to you, oh, this is how I do the process, right? And this is better in terms of communication with our clients and working with our clients, rather than asking them 1,000 questions in a checklist. If we say, show me how you do this, tell me about this process, then they're more likely to give us more detail. The other problem with checklists is that they are not customized. So that means that a checklist is designed with usually a particular industry in mind, however, not for nuances in a specific company. It doesn't take into account company size, what computer systems they use, how the company was set up, where it is in its life cycle, which means you might not have a question in a checklist, but it might be something really important that you could obtain by just asking them some questions to explain their process. So there are advantages and disadvantages to both. What we see most commonly used by firms is the flowchart option. Checklists are great for people starting out. You might interview them, take a whole lot of notes, and then go back and check against your checklist. But flowchart is really what I would prefer and what typically the industry prefers as its method of documenting internal controls. The auditing standard doesn't say which method you should use, but this is just the most common amongst the industry. So in terms of flowcharting, we've got a couple of different symbols, and I realize I've made a mistake here because I've forgotten something. But we have to have a start and an end point, and all of these symbols and shapes I'm hand drawing here, but you can actually get from PowerPoint. It's really quite cool. So you always have to have a start and an end point. Things happen. When things happen, a customer places an order, then we have some sort of process. That's a rectangle. That's the shape of mine isn't very good there. The next one is a manual process. That's when you do something by hand manually. See if I can redraw this rectangle. That's better. The next one we have is a file. It's an upside down triangle. And depending on the file and how the items are filed, especially this is mostly paper things, you might have a file that is alphabetical, you might have a file that's numeric, or you might have a file that is chronological. So you can use little symbols to recognize the type of file there. You might have a decision point. Do we approve something? Is there a yes or no point? You might have documents. So that's that little sort of wavy shape. And then you typically will have this little cylinder to represent databases or systems where information is stored. We're going to use these symbols to try and map out a process based on an example. So here's our example. We've got Felix's Fresh Fruits. They provide contactless fruit and veggie deliveries. So I'm going to start with the first part, which says that orders are received when customers place their order and pay on a website. So I'm going to draw that out first. So this is, I'm going to say here, this is on the web. So we have a start. Then we have a computer-based process. So customer places order. Okay, that order goes into some sort of system here. Now, the next step happens with Felix, the guy who owns the fruit shop. Okay, now this line that you see here, that line actually delineates different tasks done by different people. So the first task was all done online. So Felix goes into the system and he actually requests to print the order. So he print order, and that printed order comes out as a document. So customer order. Okay, at this point, they have a journal entry to recognize unearned revenue. So when he prints the order, it also triggers a journal entry. And I don't know whether it's the same system or a different system, but let's just put that little database here. Okay, a label is placed, he prepares the delivery box with the customer order. All right. So prepare order. Okay, a label is placed on the box and the order is given to the delivery driver. Okay, so we have something different happening over here with someone else. Delivery driver. All right, so the order is given to the delivery driver. Now I'm just going to use a line here. Okay, once the driver delivers the item, they use their mobile device to update the system to mark the item as delivered. So there's got to be a manual process here where he delivers item, and then in the system, oh, hang on, I forgot a step. Felix updates the computer system to mark it as in transit. Oops. All right, so we have another step. Mark item as in transit. Okay, so let's imagine this is the same system up here. Okay, then the next step is that the delivery driver delivers the item. He marks item as delivered back into this system over here, and it automatically triggers a journal entry. Okay, so there's an example of some sort of process, and you can map out any sort of process that you might see. Now, in some flowcharts that you might see online, you can do fancy things like if the customer order had a couple of different copies, 1, 2, and 3, you might have the original order go into the box, and that could go to the customer. You might have one copy go to the file, and you might have one copy go to a different department, perhaps for accounting. So there's lots of different ways that we can draw flowcharts, and that's something that you need to be able to do. I'll give you some more examples online as well if you want to give it a try. So now we're going to look at what do we do with this information about internal controls to assess whether the controls really do prevent or detect misstatements, and what should our control risk assessment be. So once we've got our flowchart, you have to look at what are the internal control activities. Will they prevent or detect misstatements? Look for any glaring weaknesses. Are there any places where things could go wrong or something that you think might not work? And then work from the assertions for the process. If this is sales, then we should have assertions of occurrence, completeness, accuracy, classification, cutoff. Is there a control for each of the particular assertions? Could I circumvent a control? And if there is a weakness, is there a mitigating control further on? So you might find a weakness early on, but they might try and detect the issue a bit later. So if we look at our flowchart here, we're going to identify the controls, and I will highlight the controls in green, all right? So we know that there is an automatic control here where the journal entry automatically happens and a journal entry automatically happens down there. But we do have some weaknesses. What happens if the order doesn't have all the right items in it, right? There's no process to check the order. We know that there's a delivery of an item. Once they're marked as delivered, there's a journal entry. But were they actually delivered? Do we have any proof that the customer received the items? So what we do is we look at the process and say, okay, could there be a problem in the part where, for example, the customer places an order? Is this information secure? When I pack the order, should I have a decision point? All right, I could have some sort of internal control that says, okay, I'm going to check the order. If it's correct, yes, then I'm going to mark the item as in transit. And then what I might do is I might actually sign the order as proof that I checked it, that everything matches off. Remember, sometimes if you get something from online shopping, and it might have, here are your items, and then you might notice on there in pen, there's little tick marks. Well, that's somebody who's packing the product saying, actually, I checked, this product has all the items that you've received. So in this very simple example, we can identify that there are some issues with the accounting process and with the business process that might result in either errors sent to customers or recording sales when they might not have been actually delivered. This could be a big problem if you're doing contactless delivery. Do you take a photo? So what could the proof be? The proof could be a photo, it could be a signature, it could be that the customer does something on an app on their end to confirm that the process has happened. So while you're thinking about online shopping, or you're watching something, or you're going for a walk, see if you can identify what are the internal controls. Could I see any weaknesses? Now remember, in my flowchart I had those different lines. We want to look at something called segregation of duties. It's a very important concept of audit, and it's different people doing different jobs. And those different jobs tend to fall in a couple of different areas. The people who will authorize a transaction need to be different to the people who process the transaction, need to be different to people who have access to any assets, needs to be different from the people who do the recording or the accounting. And let me give you an example. For example, I want to buy something for the university. Well, the first thing I need to do is I need to create a process for a request. Then that request has to be authorized by my head of department. Okay? Then that is actually processed by our manager of our school or of our discipline. The goods are then sent to the UTS central building. All right, so we don't get delivery straight to us, they go to central, and that's where the accountants do the accounting before sending the item to us. Now, why do we have different people doing different jobs? And the reason why is to minimize the risk of fraud. If I wanted to buy myself a Lamborghini, then if I could authorize the transaction, I could receive the assets and I could access the accounting, I could buy a Lamborghini with university money, potentially, which would be some sort of fraud. We also want to minimize the chance that somebody might steal an asset and then use journal entries to cover up the fact that they've stolen something, so engaged in fraudulent financial reporting. So we want to see different people doing different jobs. Now that doesn't help us if there is collusion. Collusion is people working together to try and circumvent all of these different processes. So if this person and this person were working together, they might be able to approve the purchase of some things that really aren't university money. So think about, when you're looking at your processes, should different people be doing these jobs? Does this minimize the risk of fraud? And what could we do? How would we detect collusion if we thought people were working together? So how do I make my preliminary assessment of control risk? Remember, CR is what goes into our audit risk model. Well, we have to use low, medium, or high. Remember, we don't use percentages. So what do each of the ratings mean? Well, strong internal controls and no weaknesses are typically going to be recorded as low control risk. Lots of controls, I can't see anywhere where there's a gap. If there are very poor internal controls and many weaknesses, then it's going to be high. All right, and high is my leaky bucket, my bucket with holes in it. If I've got a system of internal control that's just full of holes, it's Swiss cheese. Then I know it's not going to be a really great option for preventing or detecting misstatements. But what happens if you have some controls and some weaknesses? Well, then you're going to be in the medium range. And these are all going to affect what our level of detection risk is going to be and our audit strategy. So now let's look at control risk, the audit risk model, and audit strategy. So remember our audit risk model. DR equals AR over IR times CR. So when control risk is low, is there a higher or lower risk of material misstatement? Well, when control risk is low, think about this. There's my accounting data. Just imagine that's my blue accounting data circle here. This is my internal control system, and I think in a low control risk situation, I have lots of controls that prevent the wrong transactions from entering my accounting system. Now, what happens if control risk is high? Well, we start off with our same blue circle here of accounting data, but high control risk is when my control system might look like this. All right, weaknesses, or you have internal controls that still allow transactions in that pollutes your accounting data. So when control risk is low, there's a much lower risk of material misstatements. So what should our response be on the audit? More work or less work? Well, when control risk is low, what I'm going to focus on is I'm going to focus my audit on testing these internal controls. I'm going to test that the protective layer does the right thing. And then I'm going to do a very, very small amount of checking inside. Let me put my laser pointer. I'm going to do a very small amount of checking inside here. I'm going to look at a few transactions and just test them to make sure that they're okay. But I'm going to focus my effort on the internal control systems. If control risk is high and it's our lower situation, well, I know that, look, there's potential for all of these misstatements back here. There is no point in testing my leaky bucket because I know it's not going to work. So what I'm going to do on that audit is I'm going to spend a significant amount of time testing all of those individual transactions. And that approach we call a substantive approach. The approach where I'm going to test my internal controls, I'm going to focus on testing my internal controls, is called a control-based approach. So you're either testing lots of detailed transactions because your control system is a bit crap, or you're going to focus on testing the internal controls and only a little bit on testing your accounting information. So that's the ends of the spectrum. This is the DR high option, and this is the DR low option. All right, and here, let me get my pointer up for you. Here, in this option where detection risk is low, I'm going to do detailed checking of lots and lots of transactions because I don't know which ones are correct and which ones are affected by all these weaknesses in the internal controls. Now this one up here, my control approach, is less work than looking individually through lots of individual transactions. So, think back to my diagram from earlier. That's exactly what I was drawing there on the previous slide. So what should you be able to do? Number one, identify your components of the systems of internal control. You should also be able to document a business process. I'll give you some more examples to try. You should be able to then identify any control activities and any weaknesses in that process, make an assessment of control risk as low, medium, or high, and then explain in a very brief way how that will impact on your audit strategy. But topic 4 of this particular module will go into that in a lot more detail. So you just need to know, are we going to test the protective layer, or are we going to dive deep into the detail of the individual transactions? So that's it for topic 3, understanding systems of internal control. Of course, if you have any questions, just ask them in the appropriate channel on Teams. And otherwise, I will see you next time. Thanks for watching.